Below one of our latest real estate videos was this comment from the one next to ya. Ridiculous! That's a good way to start a comment. Don't sink your money into real estate unless you're wealthy already. I'm not gonna read this any further, you can see the comment on the screen anyway. But let's talk about the different arguments in detail in this episode of Finance Couch. Because comments and misconceptions like this are the exact reason why people don't start investing. First of all, everyone is entitled to their own opinion, so let's keep it civilized, we're all adults here. So no need to call each other names or insult each other in the comment section. Thank you very much. Now let's talk about the 5 different arguments in the one next to ya's comment. Don't invest in real estate unless you're wealthy already. The return of real estate is not worth it. Dividends are stupid. Invest in non-EU ETFs. And lastly, pick a good company stock. Don't sink your money in real estate unless you're wealthy already. The return, if any, is not worth it. Many K was going in the right direction here, and I want to expand on that. I hear the argument that something is for wealthy people only quite often, and actually most of the time I don't understand it, to be honest. Maybe next to me can help me here if he sees this video. What does wealthy even mean? When are you wealthy exactly so you're allowed to invest in real estate? And most importantly, what's the plan to become wealthy if at least some investment options are not allowed for non-wealthy people? I like that you are saying wealthy instead of rich, but I still would like to know what it means. Because I wouldn't consider myself wealthy and I own rental properties, and most of our clients that buy investment properties aren't wealthy either, if you ask me. Most of them are on a really good track to becoming wealthy, but they're not there yet, myself included. Next argument, the return of real estate is not worth it. First of all, it depends which return we're looking at. You are mentioning ROI, which stands for return on investment. When investing in real estate though, we look at ROE, return on equity mostly. Why is that? Because you put very little of your own money into the investment and get a large mortgage from the bank. And by the way, if you're not happy with the returns of renting out real estate yourself, maybe funding property developments is more for you because it can be a lot more profitable. Check out our real estate securities with sometimes up to 12% interest rate on German real.estate. Let's make 2 examples when investing in real estate, one with a down payment and one without a down payment. When you buy a property for 100,000 euro, you have closing costs of roughly 10% here in Germany for the notary, land registry and taxes. 10,000 euros. In example 1, you have a 10% down payment, which is 10,000 euro. In example 2, you finance 100% with the bank and pay for the closing costs only. Now, if the property increases by 2% as next to you mentioned in his comment, then the ROI is 2% in both scenarios, which is a net return of 2% because you can sell your investment property completely free of tax after holding it for at least 10 years. So far, both examples look exactly the same, even though they're not, because in scenario 1 you invest twice as much as in scenario 2. And that's what we use for real estate, or when investing in anything else with leverage, the ROE, return on equity, instead of ROI, return on investment. When you invest 20,000 euros and make 2,000 euros, we're talking about a 10% net ROE, and in scenario 2, with 10,000 euro investment only, we're talking about a 20% ROE net. And now you tell me your ROE when properties rise by 9.3%, 9.6%, or 14.2% as they did over the last 3 years here in Germany. Average properties after inflation, that is. What did we forget in our calculation? What sitting next to me wrote in his response comment. The mortgage is not free, of course. You have right around 4% interest rate, property manager, insurance, and all the other costs which bring down your return tax. Lucky you, all costs you have with investment properties are tax deductible, including depreciation, which you can learn about in this video on the German Real.estate channel. Of course, it will depend on the exact property and your tax situation and whatnot, but most of the time you will be cash flow negative on a pre-tax basis and cash flow positive, or at least cash flow neutral on an after-tax basis. And that's why we can ignore the monthly cash flow at this point, because you're cash flow negative as well when you invest in stocks or ETFs and receive your dividends, which are only a tiny fraction of what you invested in the first place. Speaking about dividends, they are stupid according to the guy next to you. Well, here's a statistic for you. When investing $10,000 in the year 1960, either with dividends reinvested or without dividends reinvested, if you cash out your dividends as soon as you receive them, your $10,000 grow to almost 800,000 euros, a pretty nice return, ROI of 7.4% per year. But if you reinvest your stupid dividends, your $10,000 would have grown to almost $5 million, a 10.7% return per year. Not sure about you, but I don't think dividends are stupid. For me personally, I have a €300 monthly savings plan installed that is fed by the dividends that I receive only. If I wouldn't invest any more money today, I could still keep a €300 monthly savings plan going, because that's the average dividend that I am currently receiving. You might call it stupid. In Germany we say, Kleinvieh macht auch Mist. Let me know in the comments what you think this means and if there is an English saying for that. Argument 4 of 5, go for accumulative non-EU ETFs. Here it depends what you mean by non-EU. ETFs that do not invest in Europe, like the S&P 500 or the Nasdaq 100 for example, or ETFs that are not domiciled in the EU in order to avoid the Vorabpauschale, the preliminary investment tax. If you mean the first one, then I'm afraid your plan is not working because of the preliminary investment tax. In the EU, there's no more difference between accumulating and distributing ETFs from a tax perspective. Check the video for more info. And if you mean the second one, that you invest in ETFs that are not meant to be bought by European citizens because they're not domiciled here, then have fun filing your tax declaration, because Dirk said in our last video about investment taxes that ETFs outside of the EU are an absolute nightmare to deal with. Let me clarify. You can invest in the S&P 500 or whatever you want to invest in from the EU, of course, but with ETFs that are domiciled here in the EU and not in the US. So they gotta have an WKN or an ISIN attached to it and not a ticker symbol. In order to avoid the tax nightmare, you could have the brilliant idea to not declare your income from foreign capital gains. But then you're committing tax fraud. And if I were you, there's 2 institutions here in Germany that you simply don't want to f with. Social Security, mainly public health insurance and public pension, and Finanzamt. Finanzamt and Social Security can ruin your life and ruin your life quick. So committing tax fraud just because you're too lazy to declare foreign income is a really bad idea. And the last argument, do your homework and pick a good company stock, is probably not feasible for the vast majority of people. S&P Global was checking the performance of mutual funds managed by professionals. That's a team of professional fund managers who are investing as full-time job, not your average hobby investor who does his homework as dude next to me was writing it. Over a 1-year period, 71% of professional mutual funds underperform their benchmark. Over a 3-year period, 63%. Getting better actually. Over a 5-year period, the average is 69%. I like it. Over 10 years, 83%. And over a 20-year period, a whopping 91% of professional fund managers underperform their index. Not sure about you guys, but doing your homework is probably gonna leave you with worse results than simply buying the entire stock market. You do you, guy next to me. But just looking at the numbers, the odds are not in your favor at all in about 9 out of 10 cases, and you will lose money picking stocks. Maybe you'll make a gain, but you'll lose in terms of opportunity cost. Thank you for your comments. There was a lot to unpack in this one. Hopefully you could learn something, and if we can help you improve your financial situation, then book a free meeting with us right here. Have a good one.